Weekly Economics and Finance.
The first quarter of 2024 has concluded, marking a period of resilience for the stock market despite persistently high interest rates. This resilience can be attributed to a widespread belief in the Federal Reserve's eventual rate cut in June, a sentiment that has buoyed the markets. However, the fluctuating daily probabilities of a rate cut in June have introduced a level of uncertainty that warrants close observation. Initially, the probability stood at 50.77% on March 18, surged to 67.42% by March 20, but then dipped to 55.18% on March 28, only to rise again to 61% following the announcement of the PCE inflation. The anticipation of a rate cut in June, as reflected in the Fed Watch on March 29, underscores the market's sensitivity to monetary policy signals and economic indicators. There was the release of revised U.S. GDP growth rates. The U.S. GDP growth rate for Q4 2023 was revised up from the preliminary estimate of 3.2% to 3.4%, largely due to increased consumer spending, indicating a more expansive economy than previously assessed. This aligns with the robust labor market, suggesting that employment and wages are driving consumption. The Bureau of Economic Analysis released the PCE inflation. The PCE inflation update matched market predictions, offering no surprises. The Federal Reserve's projection for an economic trajectory without overheating, aiming for a core PCE inflation rate of 2.6% by the end of 2024, remains intact. Personal income, which saw a significant increase in January, moderated in February, influencing a 0.8% rise in personal consumption expenditure, likely fueled by the earlier income spike. Notably, the PCE inflation report highlighted a marked increase in energy prices, a reversal in the declining trend of service prices, and a noticeable rise in goods prices. This shift challenges the expectation of continued product price decreases, partly attributed to China's dumping of cheap goods on the global market. The Federal Reserve faces the challenge of addressing the inflationary pressures from rising energy prices and their indirect impact on goods and services. The real estate market continues to experience a steady, albeit slow, growth, contributing to the rise in housing rental costs included in inflation calculations. The Federal Reserve's stance on rate cuts could potentially stimulate housing prices further. But the rate cut would increase housing supply that will temper any sudden spikes in housing costs. The PCE inflation announcement, overall, presents a mixed bag for the market, neither entirely negative nor positive. The Federal Reserve must closely monitor the impact of international oil prices on energy costs and their subsequent effect on the prices of goods and services. The need for additional evidence of inflation cooling remains critical for the Fed's policy direction. Looking ahead, the robust labor market, the sustained economic expansion indicated by the GDP revision, and the cautious optimism following the PCE inflation report suggest a period of market volatility. Comments from Federal Reserve officials, like Christopher Waller's suggestion to delay or reduce rate cuts in response to recent data, reflect the ongoing uncertainty. While the Fed may initiate rate cuts within the year, not necessarily in June, the market's reaction in Q2 will hinge on the depth of belief in the rate cut in June. In the short term there will be optimism and pessimism in the market, but in the long run the anticipation of rate cuts could foster a positive momentum in the market.